Okay, for obvious reasons, we're getting quite a few inquiries regarding the S&P, where we might be headed from here. For months, we've been saying we'd be willing to get bearish the S&P 500 on a move to 3,000-ish, 3,030-ish, and here we are, and we still feel the same way about it. Despite supportive seasonals in the short run, when I say short run, I'm talking about the next week or two, we see the seasonal stats actually pointing to lower prices going into mid to late July. Our friends at MRCI have put together this awesome little chart that shows us visually what that might look like. And you can see that the market generally takes a dip. It used to be everybody would always say sell in May and go away, or I'm sorry, sell in May and go away. And it's kind of become sell in late July and don't go away, but take a break. The market tends to soften up in late July, but then by late August, we're heading higher again. We generally, not always, but a lot of times we get a year-end rally, and so you can start looking for that in August. But for the time being, it's probably a good idea to start expecting some sort of a pullback in the S&P. On a fundamental note, the Fed Fund futures markets are pricing in a nearly 100% chance of a Fed rate cut at the end of this month. I mean, we've been saying this for a while, and for a while the market's been suggesting that we're crazy, but we really think the interest rate market's gotten ahead of itself. It's possible the Fed takes a small step back and cuts rates because of expectations and basically just kind of wiping out what they did at the end of last year. But we really doubt that they're going to go into a dedicated pattern that they consistently cut rates in the upcoming meetings, which is what the market is expecting. In our view, there's plenty of room for disappointment in the stock market because, quite simply, we can't see that happening. We're at stock market's at an all-time high, unemployment's at an all-time low. Sure, they might have made a mistake by raising rates that last one or two times in late 2018, but the reality is this isn't the time or place to be cutting rates dramatically. And even cutting rates dramatically probably isn't going to change the economic landscape that much. So with that said, we look to a weekly chart in the S&P, and we can see that this is the E-mini S&P futures, by the way. We can see that the market's coming up against some trendline resistance. This resistance has held a few times in the past on sharp rallies, and we think it probably will hold again. Now, markets are messy. There's nothing perfect about these sorts of things, so it's possible that we get a run into the 3,030 area, maybe even 3,040, somewhere in there. But the reality is the upside's probably limited, and in our view, the downside is relatively, I don't want to say wide open, but the bottom end of the trading channel comes in around 2,700, somewhere in that ballpark. So a correction is likely due, and that correction could be a decent-sized move. We like to take a look at the RSI, which is the Relative Strength Index. The RSI is in the high 60s, approaching 70 on a weekly chart. Now, there's no guarantees that the market runs out of steam at these levels, but more often than not, they do. When RSI gets above 70, then you start getting into an environment where the buying could dry up, and we think that's probably what's going to happen. Again, it's going to be messy, especially with the event risk over the next couple of days and couple of weeks with the Fed. But in the big picture, we probably shouldn't see too much more upside in the S&P unless something fundamentally and dramatically changes from here, which we're not expecting. We also like to look at Bollinger Bands. In a nutshell, Bollinger Bands are basically a visual representation of the bell curve. The market stays within those bands about 96% of the time, or at least that's the theory, and that's generally true. We do like to caution that sometimes when the bands are broken, they can, even though that break is temporary, it can be pretty swift. In December 2018, you can see on this chart, once the bottom band broke through, the S&P fell several hundred points before it bounced back. So Bollinger Bands are not perfect, just like any other indicator. They're a tool in the tool belt, but it gives us a good idea of the odds, and the odds are the S&P probably isn't going to go a whole lot higher from here, and if it does, it's probably not going to sustain itself. So with that said, just want to make sure that everybody understands this is speculation. It's risky. It's not suitable for everybody. If you do decide to play in the futures and options markets, just understand that it's not investing, it's trading, and we're trying to beat the markets. It's not necessarily that easy to do, although anyway, it's risky. Just keep that in mind. Don't want to make sure everybody understands what we're talking about here. And if you are interested in trading, we would love to chat with you. You can go to our website, decarlitrading.com. You'll see all kinds of free educational material, videos. You can learn before you participate. I mean, that's the goal. We want to make sure everybody understands what's going on before they actually put their money on the line. We all know everybody works really hard for their money, and so we want to make sure you know exactly what you're getting into. If you're interested in learning a little more beyond what we have on the website, my book, Higher Probability Commodity Trading, in my opinion, obviously, is a great source of information. We talk about strategies, analyzing the markets, that sort of thing. So we'd love to hear from you. If there's anything we can do for you, let us know.